Welcome, you're watching the NWR Investor Conference, November 2020. On the line, we have Genlife. Genlife has been providing Australians with tax-effective investment solutions for more than 17 years. It helps people plan for a financial future as it aims to become Australia's most forward-thinking financial services company, offering the opportunity for tax-effective and simple investment solutions. We have Grant Hackett joining us today, who is the CEO. Grant joined Genlife executive team in September 2017. With more than 12 years of experience, Grant has held many senior positions across marketing, distribution and wealth management for Westpac and BT Financial Group. Grant's qualifications include an Executive Masters of Business Administration with First Class Honours, a Diploma of Business Law and a Diploma of Financial Services. Of course, prior to his corporate career, Grant was a multiple Olympic champion representing Australia in swimming and has held numerous world records. Joining Grant today, we have Terence Wong, who is GDG's CFO, as well as General Manager of Distribution, Marketing and Operations, Felipe Arujo. Over to you guys.
Beautiful, thanks Laura. Thank you very much for the kind introduction. And thank you to everybody for joining us today. We're super excited to, educate you a little bit on our business and what we do at Genlife and Generation Development Group. So basically today we'll have about 20 minutes where we'll go through the organisation, what we've achieved over the past few years, what the strategic direction is of the organisation. And what I wanted to finish with, and it's the reason that I brought Felipe into the discussion today, was a quick overview of our main product, which is our investment bond, just to give the elevator pitch, because it's not a very mainstream product. It's getting out there a lot more, particularly since the changes to superannuation back on the 1st of July 2017, but it's always good to have a bit more education around the product so you know what we're selling as a business. So Generation Development Group, we're obviously listed on the ASX. Our ASX ticker is GDG. We're a pool development fund license. Not too many people appreciate or understand what that means. Effectively, that was something the government gave out probably about 20 years ago to biotech, up-and-coming mining firms, financial services firms. And effectively, what that does is any share price appreciation is tax-free, so there's no capital gains tax as an investor, and also any dividends that you receive are also tax exempt. So there's quite a few tax concessions that you receive if you were to invest in GDG. We've got a market capitalisation of just over 100 million. We're currently sitting just over $23 million in cash. And a recent acquisition that we obviously did a capital raise for was a 37% stake in the business of Lonsec Holdings Pty Ltd, which is one of Australia's leading quantitative research firms, whose research ratings is used by basically every fund manager, superannuation fund, dealer groups, and independent financial businesses as well. So a very, very well-known brand in financial services that I'm sure a lot of people on this call would already know about. Okay, so why Generation Development Group? Well, there's a few good reasons. The last few years in particular have been fantastic for Generation Development Group. We've shown a sustained track record in terms of our results across probably the two key metrics, which is obviously sales and FUM growth. NPAT growth has always been very, very consistent in terms of about 20 to 30% year on year. The one thing about the funds that sit on our platform, it's very, very sticky. It's about an average of 13 years that every dollar that comes onto our platform sits on there as that reoccurring revenue stream. We've got a really strong track record now of product innovation, and Felipe is going to touch on just some of the announcements that we had on Monday this week about some of our new tax-aware funds that we're launching out to the market. But not just that, we've improved the product features of our investment bonds. We're bringing out new equity income funds, and we've also increased, I think, the awareness and I think the benefits of investment bonds as a whole. I've already spoken about the licensed PDF and the benefits of that. We're very much a capital light business model. What that means, basically, we just need a little bit of operational capital, which is about 25 basis points of our overall fund. And we have a 15 basis points buffer on top of that. So obviously 40 basis points overall. We've had a very, very, positive run through the whole COVID period. In fact, in Q4 of FY20, we had our all-time record quarter in 17 years of business, and we've continued that step change coming into FY21 as well. And we see ourselves very, very well positioned for the future of financial services, given the changes of the Royal Commission, the talk around vertical integration, bundled insurance products. We're not in that position. We're very much an independent product manufacturer with a product that has a very, very strong value proposition attached to it. Okay, I'll just pass it over to our CFO, Terence, just to talk through a few of the numbers of the business.
Thank you, Grant. As you can see in the financials, these were the financials that we released as part of our full year results presentation earlier in August. What you see there is underlying revenue growth and NPAT growth have been growing at 25% a year. That's very pleasing to see. In terms of expense growth, you do see an increase in expenses, but that reflects a lot of work that we're doing in the background in terms of product development as well as automation costs that will result in future revenue streams. Then more importantly, you'll also see that we're now paying dividends out of underlying earnings. So underlying earnings was more than 2 cents a share, and we paid 2 cents dividends per share recently. And as Grant alluded to, our FUM is very sticky. You can see the strong FUM growth of 20% up to 1.3 bill. It's probably closer to 1.3 bill, 1.4 bill now, following our recent quarterly release. In terms of the cash and equivalent, we are very well capitalized. This was the cash balance of 12 million as per our full year accounts in June, but that has since gone up to about $23 million now, following our capital raise that we undertook about a month ago to fund a recent acquisition of Lonsec, as well as to fund the development of a new annuity product, which we will touch on later in the presentation. Thank you.
Great, thanks very much, Terence. Look, I'm not going to go through every single tile on this particular slide, but I think this just gives a bit of a detail on the FY20 results and just how far the business has come over the past few years. Terence has alluded to the FUM growth. You can see 48% up on sales to 332 million. Going back just a few years ago in FY17, that number was 131 million. So you can just see how much that has grown over the past few years. It's that number and the other number on this slide that I really like to focus on, that I know drives the underlying business, is in the bottom left-hand corner there, around active financial advisors, which you can see is 1,220, which is up just over 30%. That number, if you're going into the next financial year and more advisors are utilizing bonds as part of their overall holistic proposition to their underlying clients, obviously that means we write more business. And the other number to really highlight on this slide as well is how many bonds we're writing these days. It's still not a mainstream product. Like I said, we want it to be, and we're trying to get it there. And if we could pound the pavement a little bit more once these restrictions continue to lift post the whole COVID-19 pandemic that we're going through, that 9,563 number, which is up 64% year on year, is growing, close to the same rate as we come into FY21. So a lot more customers are using investment bonds as part of their overall wealth planning or wealth strategy. Another interesting stat on this slide before I move on to the next one is the fact that we take over just over 40% of market inflows. So we're certainly the dominant player when it comes to inflows in the investment bond space. This really just provides the trajectory that we've been on since FY16. So like I said, I just spoke about the number of new applications that we're writing in the business. You can see that growth there. The overall FUM going from just over 600 million in FY16, sitting at close to 1.4 billion today. The underlying NPAT growth, anywhere from 20 to up to 48% growth year on year, we've been seeing over the past few financial years. And on the far left-hand side of the margin there, you can see 25% CAGR and 54% CAGR respectively, just on sales and net inflows. So the numbers continue to consistently head in the right direction. And we're getting that fine balance of giving back to shareholders, but also retaining enough earnings to be able to reinvest back into the business so we can continue to grow at this rate or at even a faster rate. Moving into the next slide, Terence, I might just pass this over to you just to talk a little bit about the growth strategy.
Thank you, Grant. So Generation Development has been actively pursuing a growth strategy. and it's twofold. It's through organic growth as well as investment growth. So in terms of the organic growth fund, when we first joined as a management team 2-3 years ago, it was about enhancing the product features of the existing product, as well as, I guess, tweaking and optimizing our distribution footprint. Since then, we've started working on new income products altogether. So for example, this year we'll be launching the tax-effective regular income product. And then in the longer term, we announced a capital raising about a month ago where we raised $10 million to put towards an annuity product, which we will allude to. And this is focused on longevity risk in the aging population. So this is to grow organically the investment earnings and product earnings that we get. So rather than being a one-trick pony of just having the investment bonds, we are offering new products as well as a new annuity product. In parallel to that, we are also undertaking, I guess, looking at M&A opportunities. The most recent of which was the Lonsec transaction, which we undertook about a month ago, which we have raised capital for. That was to acquire a 37% interest in Lonsec. What we're looking for there in terms of M&A opportunities are businesses that are future-proof, that can leverage off opportunities that we see with the changing financial landscape. Thank you.
All right, thanks, Terence. Okay, just in terms of Lonsec and the overview of that transaction that took place that Terence alluded to. So this is a business that's been around for a very, very long time. It generates almost $30 million in revenue, close to $8 million in EBITDA. Was established back in 1994. And really, I won't go through the detail of this slide because at the end of the day, the research houses are the gatekeepers in terms of distribution for all financial products. You need a research rating if you want to get yourself on an approved product list and then be able to access that retail distribution. So to Terence's point, we really look at 4 key things when we're looking at anything from a merger and acquisition point of view. Really, one, it has to be a niche segment with high barriers to entry, which this certainly fits the bill. The other 2 major rating agencies out there, of course, are Zenith and Morningstar. The other aspect is it has to have that recurring revenue, but not just that, it has to have a great growth opportunity attached to it. I'll get Terence to touch on the next slide to talk about that in a second. And also it has to be future-proof in the new world that we find financial services in post the Royal Commission. And that's exactly what this business and what this acquisition was about for us. Terence, I'll get you to take through the strategic overview of the business and the 4 main areas.
Thanks, Grant. So Lonsec ticks all those boxes that Grant alluded to. So importantly, it was earnings accretive immediately from the point of acquisition. In terms of the business, it is a mature business. I mean, you tend to associate mature businesses with, I guess, slower growth. But in fact, we see great growth opportunity in Lonsec. On the research business, they're currently undertaking a material IT program that automates as well as puts more artificial intelligence into its research process. We see that driving a lot of efficiency gains in the short to medium term, and that's the biggest business right now. That's a Lonsec research business, so we do see opportunities there. The super ratings business is the ratings business on super funds. That's probably the stable, mature business that's probably not going to grow as quickly or flatline, if that, in terms of the overall business. But the business that we're really, really excited about is the Lonsec Investment Solutions. That is the business that had exposure to self-managed accounts. By way of context, it had a fund balance of about 660 mil back in June, and that is growing at 5% per month. That is now, just a few months in, we're north of 800 mil in fund. We see big growth in that business, and I would expect as a percentage of revenue, that 9% to increase in terms of the overall business split in the coming months or years. The other business is the R-rate business. It's got a great database there and it's used by lots of financial advisors out there. Thanks, Frank.
No problem. Thank you, Terence. One of the things that we've always been very, very excited about, Rob Coombe, which a lot of people would know, he's run a lot of big businesses here in Australia, Probably most notably, he was the BT CEO for 7 years. And he's always wanted to get his hands on this business, not just for the investment bond business, but the fact that we've got a full life insurance license, which gives us the ability to obviously distribute annuities. And there's this whole, sort of aging population, an opportunity in the post-retirement asset space where there's not too many solutions out there that provide customers a lot of value, or people are really willing to partake in there. There's a lot of people that have tried and played in this space, but there's been nothing that's really stuck. And when you look at the opportunity in this slide, it's one of the biggest challenges facing Australia is longevity risk. I saw a stat the other day and I couldn't believe this. If a female hits age 65, she's more likely to go past 97 than she is to pass away before the age of 80. Like it's phenomenal, some of the stats that you actually see coming out. So this is a real risk for the average Australian. We've seen an opportunity in the marketplace, and we've spent many years, and specifically the last 12 months, really looking at an opportunity that is unique in the landscape, that provides value to people that are going to find themselves in this situation and not too much income to live on to sustain their lifestyle. In the post-retirement assets pool today, we see $566 billion worth of opportunity. Now that's doubling in 10 years' time, and it's going to continue to accelerate more and more after that. Right now, in terms of lifetime annuities, it represents just 1% of the total pool, which really signifies the fact that there's no real solutions out there for Australians right now, or that financial advisors find that that's attractive enough. We've got an opportunity with a new product that we're looking to distribute in 12 months' time that we feel could form part of the overall solution. And I'll go through a bit of the detail without giving too much away on this particular slide. So what we've been able to develop at Generation Life is a capital light model. A lot of the time when it comes to annuities, it's very intensive on the balance sheet because you need to obviously hold capital against the assets to provide the guarantees. We've got a reinsurer that provides 100% of the longevity risk or the mortality risk. So we've been able to tick that box. It pays income for life, so it protects you from longevity. If you outlive your savings, your account-based pension, this product fills the gap, but also helps you access the age pension. Because it's a market-linked annuity, which is the first of its kind out in the marketplace. Most traditional lifetime annuities are CPI-linked or interest rate-linked. And let's be honest, right now, those products don't offer too much value. We've seen what just happened with interest rates yesterday. They continue to contract and they don't offer much value to consumers. And that's why we believe this particular annuity product is going to be the future of lifetime annuities and be able to protect people against longevity risk. It provides people to have a much higher return because it is market linked. One of the things that we were concerned around, and I'm jumping a little bit around on this particular slide, is the fact that it could be volatile. Income could rise and fall from one year to the next. But financial advisors didn't mind that because they said that's what we do. We provide advice around that. We provide guidance around that. But the fact that it actually provides you a much stronger return over the long term. And it's not just a small amount. Comparable to similar products that are out there today, this can offer up to 30% more value per annum in terms of income for the investor. We're going to be spending $10 million. It's going to be split in two parts into this particular product space over the next 12 months. $5 million will go into regulatory capital that's required to get us up to the $10 million threshold. And the other $5 million will go into the IT, the consulting, the finance systems, and obviously the personnel that we need to be able to build the product and distribute the product. We're super excited about it. We think it's an absolute game changer in this particular space and very much transformational for our business. And you can see there on the right-hand side some of the feedback. A lot of the time when it comes to product development, you get people sitting in a dark room thinking they've developed something that's the best thing since sliced bread, but they actually haven't tested it with the customer and asked them what they thought. We've received feedback as we've developed this product, and we'll continue to do that over the next 12 months because it'll mainly be distributed through the intermediary channel, of course, through financial advisors. So it's something we're looking forward to bringing to the market in 12 months' time, along with a lot of other products that we're distributing at the project at the moment. What I'll do now, I've finished up the main crux of the presentation, but before we jump into the questions, I'm just going to pass it across to Felipe because I want him to give you the elevator pitch of what an investment bond is, what the key features are, and then we'll open it up to questions for a couple of minutes. Felipe, over to you.
Thank you, Grant. I'll be brief. I'm not very good at the elevator pitch because I tend to talk for far too long. However, over the next 2 slides, what we want to provide you is with a view of what have been the strong pillars of support that have provided us in that sales growth, as Grant mentioned. And then on the second slide, just the strategies that have truly supported the renaissance of investment bonds. I will start with just a quick explanation around investment bonds. So ours is a tax structure akin to superannuation, right? However, a far more flexible structure than superannuation. And the first explanation that I'm going to take is on the first left-hand side box there that says ours has a maximum tax rate of 30%. However, in our world, we have now been able to effectively implement the notion of an income management that lowers that tax paid to around the low 20%. And we have now introduced what we're calling a capital management that lowers it significantly to the mid 10%, so akin to superannuation, in line with superannuation. Now, hold that thought. I'll explain it a little bit more on the second slide. We've got the 9 key features here, which, as I've mentioned, have supported truly the utilization of financial advisors when discussing with their clients. I won't cover them all, but I do want to highlight a few ones, starting with the fact that our structure is one that is tax paid after 10 years. So any withdrawals after 10 years are absolutely tax-free. Our structure allows for tax-free transfers to any legal entity in Australia without triggering a tax event. So to the point of the flexibility that investment bonds have that I mentioned earlier, if you were to think about it, if you were to compare to either your personal holdings or any other asset class in Australia, you cannot transfer the ownership of it without triggering a tax event. In the world of investment bonds, I can transfer the ownership of my investment bond to Grant, to Terence, without triggering a tax event. It is the only asset class in Australia that allows you to do so. You can change your investment option at any point in time without triggering a CGT. Our investment menu currently comprises of 49 investment options across every single asset class, and we are expanding. Next one that I want to focus on is the fact that the structure is creditor protected. So funds held inside the world of investment bonds are protected from creditors, and again, very similar to the world of superannuation. However, in the world of superannuation, you have to wait 26 weeks to qualify in the settling purposes before you can make that withdrawal from your proceeds inside superannuation. In the world of investment bonds, you can access your funds at any point in time. And the last one, and a very important one, and a great segue to the strategies, is the fact that investment bonds can be structured as a non-estate asset. So they bypass probate, they're not in the public domain. So in the theme of the strategies, Grant, on the next slide, number one at this point in time that we've seen is when it comes to estate planning. Very topical at this point in time, unfortunately due to a global pandemic, but we've seen investment bonds have a fantastic correlation when it comes to the intergenerational wealth transfer. Discussion of advisors now, they have worried so much about building the wealth of their clients, how are they going to pass it on to the next generation? Ours is the only one that you can guarantee that the beneficiaries will be recipients of the proceeds because it's governed by the Life Act. We have improved on that topic by adding a feature called the Future Event Facility on the 4th of December 2017 that allows advisors to nominate when and how the proceeds are going to be distributed to their future recipients. It is the only structure to do so in the market. The number one core use that we have here is an alternative to superannuation and managed funds. Now, Grant started his discussion by saying that we have now introduced to market a new tax-aware series. It has 3 tiers: the Advantage, the Enhanced, the Optimized. Let me focus on the Optimized series as it is the pinnacle of our tax-aware series and one that we have introduced, what I mentioned earlier, that capital management process that can increase the after-tax returns of growth assets on our menu between 40 basis points and up to 290 basis points. Now imagine to yourselves being able to increase the after-tax performance by that much without adding any risk. And that has been achieved by moving from a unit pool trust, where we're one of many investors, into a mandated world where the only investor, and being able to control which parcels are sold and maximize one of the key features of investment bonds, which is we can offset a capital loss with an income. No other structure in the market allows you to do so. The 3 that I'll quickly brief and then we're open to questions here is as an alternative to the corporate entity inside trust as a way to reduce distributed income, as investment bonds don't produce any income or capital gains distribution. As a fourth one that we have here, savings for a child education, one that investment bonds have been commonly used for in the past. We have now just made the structure a lot more cost effective with a broad range of investment options, making it more useful to anyone that would like to save for any particular purpose, be it education, be it house deposit, be a gap year. And I'll finish off government entitlements as a way to improve pension entitlements, as investment bonds do not count towards the income test when housed by a bonds custodian trust, which Generation Life has its own. Sorry, Grant, that's it from me there. That was quick. Apologies.
We don't normally do it in 20 minutes, an overview of the business and the product, but thanks very much for listening. Just open it up to the floor for any questions for us.
Well done, guys. Thanks for those elevated pictures, Grant, Felipe, and Terence. We have a couple of questions that have come through. Clearly, you've talked through the compelling investment opportunity of annuities, and you've effectively positioned it as an alternative to super or managed funds, particularly for retirees. Why isn't such a product on offer elsewhere already, or why isn't it offered widely already?
So when it comes to the annuity products, so the reason that this style has not been offered out in the marketplace is because the legislation didn't allow it before the 1st of July 2017. So when it came to a lifetime annuity, you weren't able to have income that could rise and fall in a given year. That legislation has obviously changed, which has created an opportunity for us to maximise, I guess, our life license within the business. We've done a lot of work talking to reinsurers, sort of product distributors all around the world to find the optimum way of doing this. And we've actually found a very, very good solution. And like I said, it's offering up to 30+% more of income than traditional lifetime annuities. So there was some legislation restrictions in there. There's also high barriers to entry because you need a life license to be able to distribute this style of product. So that's probably been the two key reasons why people haven't seen these products out in the marketplace yet.
So I'm assuming that competition may have heated up in recent years in this space and since 1st of July 2017. But you guys obviously, were ahead. Is there any opportunity to acquire some of the other investment bond operators at all? Do you see an opportunity there?
I think with the investment bond book, we would love an opportunity to acquire a good quality book, just like any other business that's looking at both organic and acquisition growth. We haven't had an opportunity to purchase anything at this stage. We haven't found anything attractive enough or anything at the right price. I think for us, because we're getting well over 300 mil worth of inflows every single year coming into the investment bond book, it has to be of quite a large size for us to look at now. It probably needs to be about 400 or 500 million plus for it to be an attractive acquisition for shareholders. And look, if there was something out there where a lot of businesses are distracted because of changes in the regulatory environment, and if they didn't want to hold on to their investment bond book and saw an opportunity to perhaps put a bit of money in their back pocket and sell it to someone like us who specialises in this space, we would certainly do that. Competition certainly has increased over the past few years. We see a lot of our competitors, broadening their investment menu, changing their pricing, changing some of their product features. So we encourage that because we want to see more people out there in the distribution in the world of investment bonds, purely because we want people to know about investment bonds because they're such a great solution as part of your overall planning. We don't call it the silver bullet. It forms part of your super strategy, your investment bond strategy, your home loan strategy, whatever it might be as an investor. It forms part of that overall landscape. So the more stuff our competitors can bring out, the more it pushes us, and the better the solutions are for the end investor.
Thanks so much for joining us today, guys, and delivering that triple threat presentation right there.
No worries. We like to mix it up a little bit. So hopefully everyone found it interesting, and thank you for the questions.
Thank you.